Hi, my name is Christopher. Welcome to this journey through accounting. Today we are going to study the chapter, which is Accounting Principles and Concepts. In this chapter, we'll explore the rules that guide financial reporting, frameworks like GAAP and IND AS, and fundamental concepts such as the double entry system, accrual basis, matching, prudence, materiality, and consistency. We'll also look at their relationships, challenges in applying them, and a case study to see them in action. Introduction to Accounting Principles. This slide explains that accounting principles are rules and guidelines for reporting financial data. They provide a standardized framework, so all companies report in a consistent way. This ensures comparability, meaning investors can compare two firms' performance. Principles also maintain transparency and accountability, giving credibility to financial statements. They guide accountants in recording, classifying, and summarizing transactions, ensuring financial data reflects reality. Generally Accepted Accounting Principles, GAAP, GAAP is introduced as the U.S. system of accounting standards. It includes principles, detailed rules from the FASB, and industry practices. The purpose of GAAP is to maintain consistency across industries, so reports are comparable. It adds credibility to financial statements, prevents fraud, and ensures transparency. For a global investor, GAAP makes analysis across companies reliable. Like Accounting Standards in India, IND AS. Here we see India's IND AS, which converges with IFRS. The implementation started in 2015, with companies adopting in phases depending on size and listing status. Unlike older Indian standards, IND AS is principle-based, focusing on fair value and disclosure. It emphasizes substance over form, meaning real business impact is valued over technicalities. The benefits include global comparability, transparency, and investor trust in Indian companies. Double entry system. This slide covers the foundation of accounting, the double entry principle. Every transaction has equal and opposite effects in at least two accounts. Debits increase assets and expenses, while credits increase liabilities, equity, and revenue. The example given shows equipment purchased with cash. Equipment is debited, and cash is credited. This method ensures the accounting equation, assets, liabilities plus equity, is always balanced. Accrual versus cash basis. Here we compare two accounting methods. Accrual records income when earned and expenses when incurred, giving a more accurate financial picture. Cash basis records only when money actually moves, which is simpler but less informative. GAAP requires accrual for most businesses. Small firms sometimes use cash basis for simplicity. The example highlights how the same sale is recorded differently under each method. Matching concept. This slide introduces matching, a core accounting principle. It ensures expenses are recognized in the same period as the revenues they generate. This prevents overstating or understating profit in any one period. Applications include depreciation, accrued expenses, and prepaid items. An example is sales commissions being matched to the sales they relate to, even if payment happens later. This principle makes reported net income more accurate. Prudence and materiality. Two important principles are explained here. Prudence, or conservatism, requires not overstating income or assets while recognizing potential losses early. For instance, inventory is recorded at lower of cost or market value. Materiality states that only items significant enough to affect decisions must be recorded in detail. What is material for one company may not be for another. These principles keep reporting practical and realistic. Consistency principle. This slide highlights the need for consistency. Once a company adopts a method, like FIFO for inventory, it should stick with it unless a valid reason arises. Changes must be disclosed along with their financial impact. Consistency makes statements comparable across years, which is vital for investors. Without it, analysis of performance would be unreliable. Concept of true and fair view. This principle ensures financial statements reflect actual business reality. It demands unbiased, complete, and relevant information, In rare cases, a company may even depart from a standard if following it would misrepresent reality. This overrides technical compliance and emphasizes economic truth. It reassures stakeholders that statements show a genuine picture of the business. Practical application of principles. Here we see how principles guide daily accounting work. Accountants follow steps like identifying, recording, posting, analyzing, and preparing statements. Each step applies principles like matching, prudence, and consistency. For example, matching aligns expenses with revenues, while prudence avoids overstating assets. These applications ensure statements are trustworthy and decision useful. Relationship between principles. This slide shows that principles form a connected framework. GAAP provides the foundation, while concepts like prudence, matching, consistency, and true and fair view interact to create reliable statements. For instance, consistency supports comparability, while prudence adds credibility. Together, they produce financial data that is reliable and useful for decision-making. They cannot be applied in isolation, but must be integrated. Challenges in applying principles. Challenges arise when applying principles. Accountants must balance prudence with fair representation, which can be subjective. Materiality thresholds differ by company, adding complexity. Global changes, such as transition from Indian GAAP to Ind AS, require adaptation. Best practices include training, policy documentation, expert advice, and robust internal reviews. These practices reduce errors and maintain quality in reporting. Case study, ABC Manufacturing Limited. The case study demonstrates multiple principles at once. ABC received advance payment in March, but under accrual, revenue is recorded only in June when goods are delivered. Production costs incurred earlier are matched with June revenue. Prudence requires accounting for risks like product returns. True and fair view ensures statements reflect real economic conditions. This case shows how interconnected principles shape correct reporting. Summary of key principles. This slide reviews the key principles covered. GAAP and IND, A's create reporting frameworks. Double entry keeps balance, while accrual and matching give accurate timing. Prudence and materiality make reporting conservative and practical. Consistency provides comparability, and true and fair view guarantees accuracy. Together, these principles form the foundation of accounting knowledge. Closing perspective, implicit, Jachya title slide. The final slide wraps up the chapter. It emphasizes that understanding principles is not just academic, it's essential for practice. These rules guide accountants globally, ensure fairness, and create trust in financial reporting. As future professionals, you must know how to apply them and recognize their limitations. This prepares you for advanced topics in taxation and corporate reporting.